Oh, hey friends, Josh Yeager, Santa Barbara dog walker and fiduciary governance nabob. Out with the dog Dodger, taking a walk. Check this out, Dodger. Dodger, what's up, buddy? Hey, buddy. Awesome. Okay, we're gonna continue the conversation about establishing return objectives and risk expectations for a trust. This is one of the trustees' duties of care. In California, it's 16047B. Says that the trustee shall establish return objectives and risk expectations consistent with the trust purposes. Pretty much every other state has the same language. So how does the trustee fulfill that duty and create a memoranda for their files so that they can prove that they have been a good trustee in anticipation of a knucklehead beneficiary saying they haven't been? Well, as we talked earlier in this walk, we talked about the need to establish a return objective and risk expectation. We shouldn't be wishy-washy in our definition. We shouldn't say the return objective is somewhere between 3% and 8%. We shouldn't say that the objective of the portfolio is a primary objective of growth with a secondary objective of income. We shouldn't say that the risk for the portfolio is expected to be moderate, because you can't measure any of those things. You can't tell if the portfolio accomplished the objective of growth with the secondary objective of income. We need to be more precise. And this isn't just me saying it, it's the CFA Institute saying it, it's ERISA courts saying it. It is the standard. So, what do we do when we have assets in the trust that aren't susceptible to easy identification of return or risk? So if we've got the portfolio with the helpful folks at Morgan Stanley, who built us a nice portfolio of stocks and bonds, and we're able to say, look, past performance is no indication of future return, but the return objective is nominal return of 6% or inflation adjusted return of 3%. We call that a real return above inflation of 3%, with a standard deviation of 70% of the S&P 500 or 10 basis points or whatever the investment advisor says. Side note, I'm not expecting the trustee to be able to know how to calculate these numbers. I'm expecting the trustee to ask for these numbers. And if the trustee asks for the numbers and they get an answer, which is, oh, it has a moderate return objective and a income, secondary objective of income, I want the trustee to say, nah, fellas, this is a job description. I need to be able to identify whether you did your job, and that's not enough detail. So what do you do about the Morgan Stanley guys can help you with the definition of these things for liquid assets. What about for illiquid assets? What if the portfolio holds an apartment building in Long Beach? How do we define a return objective and risk expectation for that? Well, return objective, it's not unreasonable to collect data. Hey, Dodger, we don't want you going off the cliff, buddy. Hey, get back up here. The dog's trying to escape. It's not, look at that. That's insane. It's not unreasonable for the trustee for their apartment in Long Beach to say, what has the return of apartments in Long Beach been over the past 20 years? There are real estate agents, there are databases, there are appraisers that can answer that question. A informed trustee will take the time, if they decide to keep the apartment building in Long Beach, to come up with a reasonable estimate of what the long-term appreciation characteristics are of that asset class. This isn't a crystal ball. This isn't the trustee has to be able to predict the return outcome. The trustee has to make an effort to identify an outcome. Act prudently by identifying an outcome. So pretty much every asset that is held by a trust, some appropriately footnoted exercise can be done that identifies the trustee's expectations around future return. If the trustee has no expectations around future return, I don't believe the artwork will appreciate. I don't believe the house in Tahoe has any opportunity to grow in value, why would the trustee keep that asset? Sidebar, we'll get to it. There are instances where a trustee would keep assets that don't have any performance if they have particular importance or significance to the family, but not big assets, not investment assets. So how do we deal with risk? So there's three kinds of risk. I'll go differently. There's a whole bunch of kinds of risk with illiquid assets. One of the risks in portfolios is excessive concentration in one thing. Too much of a good thing. Too much of the low basis stock in the company that Grandpa started. Too much of the portfolio or the trust assets in the ranch in Idaho. So excessive concentration. Another risk of the illiquid asset, the apartment in Long Beach, is excessive leverage. Kind of the leading contributor to trustees blowing up trusts is debt, not equity. Leveraging too much on real estate or other assets. The other kind of risk is the inability or difficulty in defining the value. There just haven't been any ranches in Montana of this size sold in the last 5 years, so we don't actually have any idea what the thing is worth. We may have long-term return expectations, but there aren't a lot of data points, unlike having the price of Amazon stock reflected every nanosecond so that we know what the value of the thing is. Those are some of the risks associated with illiquid assets. Oh, guys, he found a buddy. Yeah, I worry about the cliff too. Back in a minute.